a lot of nervousness, a ton of headlines coming at you these days. How do you invest around this? Where is the safety asset right now? Chris Hyzy is joining us right now from U.S. Trust, a division, a part of Bank of America that oversees about $188 billion. Chris, you say, welcome to the global rebalancing.
Yeah, that's right, Margaret. We've been talking about this actually for a few years, but it's really picking up steam. You could see it on various corporations. You know, obviously the news today on the spinoff in Kraft and others. You're getting this huge movement to follow the money, and the money is in the pockets of emerging market consumers. And it's the biggest single reason why corporate America and our profit cycle in the United States is hitting new peaks this year, likely to hit another new peak next year, even in the face of all the dragons that we talk about and that's happening in Europe and that's happening with the debt ceiling talks last week, and also the potential for a downgrade down the road of our own debt. Even in the face of all that, you see a profit cycle that's hitting new peaks, and that's global rebalancing, and that's the global economic curve, not just the U.S. economy.
No, and well, once again, we get this reminder out of Europe that the debt crisis hasn't gone away. You see panic seep in, and you get more and more questions from investors these days about alternatives to equities. What are you telling your clients right now?
Well, when you take a look at what's happening in Europe, notwithstanding the fact that it's still very tight policy. I mean, the ECB is actually pulling euros out of the circulation, which is causing deflation over there. So when you look at that and you look at the economic bite that they're about to go under, and the fact that there's some very big worries about the financial system through the banking system, you get a weak euro over the next year, 2 years, possibly 3 years. So we want to look at capital market strategies that are able to take advantage of a weak euro. You want to look at yield curve strategies on the euro yield curve versus what's happening here in the United States. And at the same time, from a defensive perspective, within equities, it's dividend-producing companies around the world with excess revenues coming from overseas that are going to benefit from the weak dollar versus the surplus areas of the world, which happens to be Asia and some parts of Latin America. On the fixed income side, you still want to use large down days when they throw the baby out with the bathwater, when a particularly low-quality concern enters into the equation and it takes down a high-quality bond with it and yields pop a little bit. That's where you want to be very selective in credit, and that also includes the municipal landscape as well.
So you would be recommending debt markets right now, but looking at your reflation investment strategy, as you put it, you're telling people timber, farmland, and non-U.S. real estate. That almost sounds like the kind of strategy where you're bearing cash. Is that really like your safety play right now? Buy real estate, buy farmland?
You know, to a certain extent, that's a good way to put it. It's also a benefit of what is happening with this global rebalancing. It's probably the largest benefit of what's going on with global rebalancing. If you think about the 1990s, the growth sector was not technology. It was the U.S. financial system. It fed the U.S. consumer. That will have to be unwound through debt pay downs in the public sector. As that happens, the surplus overseas, particularly in the emerging markets and in Asia, they're going to have to diversify their dollar assets. What better way to do that than timberland, farmland, hard assets in general? A whole new world infrastructure is needed. It doesn't take a year or 2 years. It takes a decade for this to play out. So farmland, timberland, real assets in general are still the place to be, even in the face of what we're seeing going on in Europe and other places.
What about gold? I'm looking at gold up on the screen here. $16.80 an ounce right now.
Yeah, you know, gold and silver on the precious metal front continue to be hedges against, obviously, fiat currencies, particularly the dollar, and its decline. Overall, I think gold and silver prices have pretty much run their course on a week-to-week basis. That's not what we do. We're longer-term investors, obviously, but from the standpoint of where they are right now, I think it's the fear trade, and it's a complete hedge. It's not necessarily an investment, and that's important to understand when you talk about portfolio construction.
Right. I know you hear this is a trader's market, not necessarily an investor's one. You're talking to people who you're trying to encourage to invest. On the equity side of things, I mean, for an American corporation, you pretty much want a U.S. company that makes most of its money overseas right now.
Yeah, you know, if you think about it, many market prognosticators and experts a decade ago told you to go to the large cap multinationals to get access to the non-U.S. markets, and that was the way to invest back then, and it didn't work. It didn't work because most of those companies had less than 10% of their revenues and profits coming from overseas. Today, you have many companies north of 50%, north of 60% getting their complete revenues and profits from overseas, with an emerging market consumer whose demographics are only going to get better. When you talk about the emerging markets, it's still very important to be country specific, but in the United States, it's company specific, and that's really what we're trying to do.
Chris, you already said you would reconsider your overall investment strategy if the European financial crisis really does once again pose a systemic risk here. Is today the day when you start rebalancing and reconsidering some of your projections?
Not moving away from the reflation trade just yet, but in terms of what's happening in Europe today and what's likely to happen in the coming weeks, until you see a final capitulation from the ECB or the funding facilities to actually do some sort of a quantitative easing approach, at this particular time, we're not going to change our strategy. We don't think the magnitude or the impact is that great on the profit cycle in the United States, which is the hallmark of our reflation stance.
How much cash are you holding on to, given what we just saw in terms of buying of treasuries right now? What's your recommended allocation in your portfolio?
You know, we still have a low allocation to cash overall. When cash comes in, when shorter-dated bonds actually mature, and we've been on the short duration side in fixed income, when that actually matures, we're looking for outsized opportunities across the entire asset class spectrum, whether it's equities, fixed income, in the alternative space, and the other areas we mentioned before in real assets. It depends on actually where those targeted opportunities are. Right now in the marketplace, it continues to be very large corporate America that we're looking to pick up better positioned prices at. So we constantly are rolling off cash and rebalancing. And until this rebalancing theme goes away, the reflation investment stance is going to be what we continue to use.
Chris, thank you very much.